All right, guys, welcome to today's training where we are in a world in which the stock indexes have forgotten how to go down. Right? Like they just go up and up and up and up and up, and nothing really seems to be slowing them down whatsoever. But that's the nature of the markets. It's a weird thing. A lot of times it does not make sense. We can't wrap our heads around it, and we're not necessarily supposed to, right? Like we don't have to have an explanation for why it's doing what it's doing. We just have to react to what it's doing, and that's where we make our money. But we're going to walk through. I just recently uploaded the completely revamped entire course for the Stocks for Pastors trading system. And I don't know if anybody on the call has had a chance to go through any of that yet. Some of it will be familiar to you, some of it will not. But we also are recording this to use as a helpful resource for those who are not yet part of the Stocks for Pastors community. And so they're going to be wanting to see kind of an overview of what we do, what this whole thing is about. And so I figured that this training session would be a good opportunity to just look at the entire program as a whole from a 30,000 foot view. Now, in that redo of the entire course, I put a lot of time and work into creating it, and it's about 4 hours worth of material. So obviously, we're not going to cover the entire thing in this training here, but I'm just going to give you a summary of it all. And if you have questions along the way, I'll pause periodically to let those who are live on the call ask questions. And then if you are watching the replay of this, then you can message me with questions, pause, go back, whatever. But just know that the full details of everything we're talking about here today are explained thoroughly in the actual program. All right, so let's go ahead and start moving through all of this. And here is just the overview of the entire system. So I've broken it into four different modules. We have an orientation and framework and kind of the mindset behind why we're doing what we're doing. How to look at market structure is module two, and how we understand and interpret what the market is doing. Then risk and sizing is module three. So even if we can understand where the market's at, we're reading it right. We even maybe understand the setups, and we can have good trade execution. If we don't get our position sizing right, that's going to hurt us. So we want to focus on how we structure our sizing, where we allow our risk or our loss to get us out of a trade. All of those details in module three. And then in module four, we talk about the actual strategy. So there's four strategies, two of which are already familiar to you guys that have been with me for a while now, and then two that are probably going to be somewhat new to you. All four of these use options, and if you are not experienced with options, you don't know what those are, maybe you're just testing this out and you've never traded options before, there are a couple of free courses that I have. One that's just a stocks for beginners, just the basic what is the stock market, how does it work kind of a approach to things, and then a introduction to options trading course. Both of those are completely free in the learning section. So go look at those, and that will help all of this make a little more sense. But fortunately for today, we're not getting into the actual option structures and what all that means. We're looking at the bigger picture, right? So when we begin this journey, we're going to start by focusing on our mindset and how we approach the market. And as in every area of life, I think as Christians, those who adopt a biblical worldview of things, that framework colors everything we do in every area of life, whether it's in your work, whether it's in your hobbies, whether it's in the way we approach the markets. The Bible has a lot to say about what we do with our money. Right now, obviously, it doesn't say this is the stock you should buy, and here's the price you should buy it at, and here's the price you should sell it at. That's not the point of the Bible. But it does tell us a lot about managing our risk well, stewarding our money well, seeking a good return on the money that God has entrusted to us. All of that the Bible encourages and us, and I would even say commands us to do. And so we're basing everything around a biblical view of money. And I came up with these four principles of faith-driven trading or faith-driven investing, and they all come from a different proverb. So first is principle number one is that risk comes first. We are always going to pay attention to what we can lose on a trade before we look at what we could potentially make from a trade. A lot of times I've seen traders, and I've been susceptible to it myself. You structure an option position and you look at that risk graph and you see the payoff potential. Man, I could make $2,000 on this one trade, or I can make $5,000 on this trade. This is going to be great if I make that much money, and I don't really pay attention to how much I could lose, and then I end up taking a very large loss, a much larger loss than my account should, and it's because I didn't pay attention to risk first. Risk always comes first. Discipline is non-negotiable is principle number two, coming from Proverbs 13:11, which says that wealth gained hastily will dwindle, but he who gathers little by little will cause it to increase. And the driving force behind that verse is that discipline is the key to it, that we're not seeking home run trades. We're not, playing the lottery. We're not gambling. We're not taking huge risks for huge payoffs. We're chipping away at things little by little. We're adding to our account, growing it over time, and building it over the long term, not thinking over the immediate future. Principle number three is, as I just alluded to, trading with the long view in mind. We're not just paying attention to any one individual trade, and we're not making a judgment call on our strategy or on ourselves as traders based on 1 week, right? If you have one bad week, it doesn't mean you're a terrible trader, doesn't mean that the system doesn't work. And on the other side, if you have one good week, it doesn't mean you're the greatest trader ever, and it doesn't mean that this strategy is foolproof, right? Like you can't look at it that way in terms of just a single event or a very confined time of reference for this. We have to be thinking bigger picture, longer term objectives in mind. And so we're playing the long game here with this. And so we're committing our plans to the Lord and looking at a distant future of how this develops over several years, not over any individual trade. And then principle number four, this one's maybe a little controversial in today's age, that I don't think that trading and developing an edge and being a successful and consistent long-term trader, I don't think that can be done through copy trading. Now, there are tons of, AI resources out there. There's all kinds of algorithms, bot traders. You can sign up and give a company your money and let their bots trade your money for you. And so they are copy trading based on a very firm mechanical rules of things. But from what I have seen, what I have experienced, and in talking with even with people who have designed some of those programs, is that they work really well sometimes and they work really not well other times. And it just the nature of how the markets operate, which you could make the case that even though it's dollars and cents, that it's in a financial framework, at the end of the day, the stock market is based on human psychology. Greed drives price up, fear drives price down. It's all based around how we as humans emote around an opinion on the value of different securities, right? And that is not something that you can program into a computer and it be super efficient. So my objective in this whole program is not just to give you trades that you can copy. Even though we do make that easy for you to do with literally one click of a button, and you can load the trade alerts that I send out into your platform. We do make that simple, but that's just part of the learning process. That's not the end goal, right? I don't want you to be dependent on me to get your trade signals 2, 3, 4, 5 years from now, right? By then you should be at a place where you can find your trades your own, you can manage them yourself, you know what you're doing, and you're growing as a trader, and that is the ultimate goal in all of this. So we're not just a signal service. Oh, this is a guided program to help you learn how to do this over the next couple of years. So these are the four principles that are baked into every decision that we make. And the reason we start with these principles is because I have seen over and over again, and admittedly have fallen into this trap many times myself over the last 15, 20 years, is the strategy hopping cycle. Now, tell me if this sounds familiar to you. So, step one, you discover a strategy. You learn a trading strategy. It looks really promising. You're hopeful on it. You learn the specific setups. You apply it, and you start making money with it. And you think, man, this is great. I'm going to replace my income. I'm going to get rich from this, whatever. And then the market shifts, and you start taking a couple losses. Things aren't going quite as well, and your confidence starts to drop, and you think, oh man, this strategy doesn't work. I got, beginner's luck. I got lucky at first. The strategy doesn't work. I got to find a different strategy. So you go and you find a different strategy and you learn it and you get excited about it. You apply it and you maybe even start making a little money. And then the market shifts again. You start losing money. Your confidence drops. And again, you go, oh, well, this one didn't work either. Now I got to find another strategy. And you just get caught in this loop where you're going around and around and around, not knowing that you ultimately are in the trading account graveyard just with a lot of activity around it, right? That's what this looks like. So does that cycle feel familiar to anybody? Anybody can like resonate with that? Or any questions from you about the framework before we move on to the next piece? I'll unmute us if we have questions. Okay, awesome. So let's keep going and let's figure out how we avoid that cycle and what we need to get out of that rhythm. And there's three pieces to it because ultimately what we're trying to do here is develop a skill set. We're learning how to trade. We're learning how to manage risk well, how to build something through this. And that requires a certain level of skill that you have to develop over time, right? And so I think developing any skill, whether it's trading or in any other area of life, there are three components that you need to do it. And because I'm a pastor and we like to alliterate things, these are three different E words that help us know how to develop a skill: education, experience, and edification. So the education component is the course itself, the videos that you have in the program. That's where you're going to learn the entire framework, how we structure everything, the whole philosophy behind it, how we understand the market, all of that, along with the language and the exact vernacular that we use, so that you learn the vocabulary, all of that components that go with it. This is just the information component of learning that skill, right? So this in as you go through those modules, which there's four different modules, about 15 lessons. I tried to keep them all in the 15 to 20-minute range. A couple of them go a little bit longer than that, and some of them are a little bit shorter, but trying to keep them all short. But this is the information component of learning that skill. And then we have the experience piece of it. This is where you just kind of, education can get you so far, right? You can read a book, you can watch a course, you can do all those things and gain some knowledge, but until you actually experience it, until you practice it for yourself, your learning, your growth in that skill is going to be really contained, right? So the experience piece is the trade alerts that we send out every week and interacting on the platform and asking follow-up questions and seeing how all this works, executing the trades yourself. For many of you who are just beginning, doing it in a practice account where you're not risking real money, you're just learning the rhythm of, I click this button to do this and this button to do that, and just knowing the ins and outs of how the thing works by hands-on experience. And then you're gonna, this is where you're also going to kind of develop the judgment of, okay, so I like this, I like this particular strategy. Now that I've done a couple of them in a practice account for a while, I'm starting to learn that I lean more toward this strategy instead of this strategy. And you just kind of know into it by experience how all of that plays out. And then the third E is the edification piece. This is where most people in a community like ours drop the ball. We maybe do the hands-on stuff, we go through all the course, but we don't engage in the community. And by that I mean this is where you guys who are live on the call, or those who typically join the call but just couldn't today for whatever reason, you're watching the recording. This is part of the edification piece that we're engaged in live, interactive conversation with others around the material. So we're in the coaching call. We're commenting on the trade alerts. We are providing feedback to others. We are even posting in the trade member trade reviews where you have a trade idea and you post it in there for other people to get feedback on. And I know that can be kind of daunting, especially if you're a new member or you're newer to trading and you're think that what you're structuring maybe doesn't have value, or you're just not sure that that I understand this well enough to put my trades out there. And I would tell you that that's actually not true, that you are going to learn the most and others are going to learn by putting your trades in that trade review. So I want to encourage you guys, make use of that space. It is going to help you. You're not going to grow as strongly as you could if you are not actively engaged in the community. And plus, if you're not posting in there and I'm not seeing all this, it's going to be really hard for me to help you. I won't know how to help you grow as a trader if I don't see that side of it. And you're not going to learn from others. Others aren't going to learn from you. So you really need to engage into the edification component of this well. So education, experience, and edification, all three are needed to become proficient at a skill. So let's walk through the next step of this, which is understanding market structure and how we interpret what the market is doing. And we use VWAP to do that. So the module 2 gives you the decision lens of how we understand the market and what it's doing, as well as specific setups that we look to utilize and some context tools around doing that. So there are 3 different setups that we use here: the continuation, the fade, and the reclaim. And so a continuation, if I'll just pull my little highlighter up here. Continuation trade is when in a trending market, when the market is going one direction or the other, could be up or down, but we have a sloped VWAP that is angled in a direction, prices continually making higher highs and higher lows, and then we get a pullback to either the upper band or to VWAP itself, and then a reaction from that, continuing that move, hence a continuation trade. This is one of the behaviors that we are looking for to take our trades. When price is trending, it pulls back to these key levels. That's where we become interested in taking a trade in the direction of the larger trend. Behavior 2 is when VWAP is flat and the bands are relatively flat and price is just kind of moving back and forth around inside of value. When it reaches an extreme or an edge of one of these value areas, that's when we're looking to fade that move back down into value. And then behavior 3 is a reclaim. So price has been trending in one direction and then turns the other way. Once it comes back and reclaims VWAP and gets on the continuation side of VWAP, that is another signal that we are looking for a resumption of that prior trend. That in this example, we've had a pullback and then we come up and close above VWAP. That is a sign that the bulls are back in control of this market, and it is going to likely push back higher up to the upper band again, and then sometimes and oftentimes clean through that as we go back into a price discovery mode. And then once that happens, we're looking for a continuation setup just like this. So those are the 3 strategies. So VWAP it doesn't predict where the market is going necessarily, but it does give us a clear roadmap or a clear picture of what the market is doing, of where value is currently relative to what the price is, and price and value are not the same thing, right? Keep that in mind. And so we're watching price to see how it reacts at agreed upon value levels. And we want to see price explore higher value areas or lower value areas, or we want to see price bounce around inside of value areas, and we can structure trades based on that. So that is the three behaviors or setups that we look for in this system, and we'll spend more time on each of those in the actual course. But hopefully you can already see based on this kind of how we get some structure to what we're doing and how we think about what we're doing, maybe a little more clearly than just simply guessing of, hey, I think the market's probably going to go up today, and so I'm going to put on a bullish trade, right? Like we're putting a little structure to what we're doing. Any questions from the live audience at this point? Awesome.
So
Let's
you're
move on.
just using
Oh,
sorry, I had to unmute. It's kind of hard
yeah.
to do a question. So you're using the VWAP, the upper and the lower bands, to identify what you believe the trend will be for looking forward.
To identify, um, I don't want to say to identify what the trend will be, because obviously in a fade scenario we don't have a trend, right? So I'm looking for reactions at those levels. And the reason for the reactions at these levels is because inside the bands is where value has been agreed upon in the past. It's one standard deviation from the volume weighted average price, right? So that gives us our current value of that stock. And so when price reaches, maybe if we are flat, which means we have pretty good acceptance inside of value. When price reaches one of the extremes, well, now we've got to the edge of what is accepted value in a market that is not trending. The logical or the natural thing to think that when we get to an edge, we get a reversion back into value, because there is no clear trend yet, right? So we're looking for it to react to this level and come back down into value. Does it always do that? Absolutely not. Sometimes it will just push right on through, and we go into a price discovery mode, and we're pushing to newer highs, or we're pushing to lower lows. But we're looking for a reaction at that level. Same thing on the continuation one here, where we have acceptance above current value, meaning the consensus on the market is that price should be higher than its agreed upon value, which is why buyers are stepping in and buying it, because they think it's going to keep going higher. But then we get a pause, and we come back to that value area that has previously been rejected, and now we get to test this again. Are we, in fact, going to continue rejecting value and push for newer levels, or are we going to turn into a more of a neutral thing here where we stay inside of value, in which case the trend is over, right? So once we see some reaction at these levels, that's when you know, okay, the trend is continuing, and so we are using that as our means to um, project where the market will go from there. Does that make
Yeah,
sense?
thank you.
Yep. Okay. Module 3 is all about risk and our position sizing and our compounding. And so we've got a couple of rules that we walk through in this module about how we define our risk. And we always define our risk. We don't, in the option spreads that we create here, we don't structure them in a way where we have no risk, or we're taking disproportionate risk to what we're doing. We don't want to see, a trade where we have, $1,000 of risk to try and make 50 bucks. That doesn't make sense, right? That's way too much. It doesn't matter if it's a 99% probability of profit. It only takes one loss in that scenario to have wipe out, 100 prior winners, right? So we don't want to do that. We define our risk, and we know what we are willing to risk and where our entries and exits are before we ever get into a position. And we know how to size our position. So we use a unit-based system that is going to help us stay consistent in our sizing, and then we compound that accordingly. So we add to our position size as we realize profits. As we take losses and our account balance drops, we reduce our position size. A lot of traders fall into the trap of, after they take a loss, they need to trade larger to try and make back the amount that they lost, right? So if I lost $500 on a trade, I need to trade twice as big next time so I can make money plus make up the 500 that I lost, which is a recipe for blowing your account. We don't want to do that. We want our position sizing to fluctuate with the growth of our account. That's how we stay alive in this business long enough to let our edge work out for us. And so we'll provide you a table like this, like a fixed ratio compounding table that shows you at what intervals you should increase your position size based on how much profit you have realized in your account. All right. So, moving on to the final piece of this is our module 4 is the actual strategies themselves. And we have 4 different strategies that I teach in here: the double canopy spreads, the cash flow collective, which are the two that those of you who have been with SFP for any amount of time are already familiar with. But then I'm introducing 2 additional strategies in here that are completely optional. You don't have to trade them. You don't even have to watch the lessons on them if they're not of interest to you. But they are very powerful strategies that, and maybe a little more advanced strategies that you can implement on your own, based simply on the material you get in the course itself. The DCS and the CFC strategies are ones where I will provide real-time alerts, and so you will get to see those exact trades and be able to watch those and follow those, place those yourself in your own account as you learn. I'm not, as of this recording, I'm not doing real-time alerts on the UBS or the SRS strategies, but that is always subject to change. So let's take a few minutes and let's walk through each of the 4 strategies individually here. So first up is the double canopy spreads, the DCS. And this is one where we use primarily SPY or QQQ. So we use the index ETFs for this because they are highly liquid. They are less susceptible to huge price swings, like you could get in some stocks where you might get a 10 or 20% jump in a single day that could just devastate a stock position or a spread position. Very unlikely that you see that kind of thing in these. A 2% move in a single day, like we're seeing right now, is actually relatively unfamiliar or very not super common. Except over the last couple of weeks where QQQ seems to go up 2% about every other day. Um, so, but we're using SPY and QQQ. They are the 2 most liquid, most traded securities on the exchange. And so they are going to be great vehicles for implementing this kind of strategy that has very short-term durations in our trade structures. And because they are so liquid, they have expirations every single day of the week: Monday, Tuesday, Wednesday, Thursday, Friday. They have option chains that expire every day. No one else does that other than S&P 500 and the Nasdaq. There are some others that will do Monday, Wednesday, Friday, but most individual stocks only do every Friday expiration or only every third Friday, so just monthly expiration. But these 2 beasts are so big that they have daily expirations and plenty of liquidity to trade any single daily expiration that you want. But we're structuring these around 4 to 8 days until expiration. These trades we are in usually less than a week. We typically put these on. I send the report for this out on Thursdays, and a lot of people will place a trade on that day when this report comes out. because I give you three different variations: a neutral, a bullish, and a bearish. And based on your bias of where the market is right now and where you think it's going to move to over the next week, you can place one of these spreads based on that bias. So if you're bullish this week, you can put on a bullish trade. If you're bearish, you can put on a bearish trade. If you think it could bounce around and go either way, you put on a neutral trade. Some traders like to do multiple ones. They'll do a bullish and a neutral, or a bullish and a bearish, and play a bigger swing in one direction or the other. And be positioned for either one. So there's all kinds of ways that you can do this once you understand the structure and how we set these spreads up. The other way to approach the DCS is to not take the trade as they are released on Thursday. I just send those out on Thursday, not because there's anything special about Thursday necessarily, but just because that's a great time to give you the structure of how these spreads are aligned. And then you can just use that structure that we have for that week's spreads and wait for one of those setups that we just talked about, a continuation, a fade, and then apply this structure to that particular setup. That's a more that just introduces a level of precision into the trading that you wouldn't get by placing your trade every Thursday when that report comes out. So there's a trade-off there, right? You may not get as many signals, you may not be able to place all the trades if you wait for the setups, but the trades that you do take are probably going to have a higher win rate, and you're going to be a lot more precise in your entries and when you can take profit and that sort of thing. So a couple of different ways that you can play DCS. But that's the goal of what we're doing with this. We're creating a three or four-legged option spread that has a pretty wide range of break even. So you have a high probability of success with any one of these trades. The risk reward metric is very good on these on an individual basis. And so that's just a great way of approaching the market if you want to be actively involved in trading the equities on a daily or weekly basis. These are not the kind of trades that you want to just place on and then not look at again until the following Thursday, right? It's just not probably not a good idea to do that. You're going to want to pay attention to these at least daily. You don't have to sit in front of your monitor and watch them all the time, but you are going to want to check in on this at least once a day when you have these trades in place. If you want something that is maybe a little bit more window on this and you just want to check it once or twice a week, then the CFC is the better approach for you. The cash flow collective. This is one that utilizes individual stocks and sometimes ETFs. And we're aiming at a 3 to 5 week window for these trades. They're going to last a couple of weeks rather than just a couple of days. And we're going to trade a variety of spread patterns in these types of trades. We will sometimes just do very simple like credit spreads or calendar spreads. Other times we'll do the more complex 3 or 4 legged like double diagonals, double calendars, those kinds of strategies and vertical combos. There's a lot of different ways that we will do this, and I explain most of them in the course material itself. But the idea here is to put on one, maybe two trades a week that will allow you to build up a portfolio over several weeks of multiple different positions that sometimes complement each other and occasionally run contrary to one another to offer a little bit of a hedge. But it's a way of building out a longer term portfolio that you don't have to manage quite as closely. Still have to be active with it, but it gives you a little bit more time for trades to work out. And all of these trades have good risk reward metrics as well. We're aiming to take 20 to 25% return on our capital on each of these, risking roughly the same on them. But we're looking to use something here that will help us build out a slightly longer time frame type of rotating portfolio where we can just on a monthly or every 6 weeks or so just constantly rotating the capital that we've allocated to this, just going back and forth and utilizing that capital over and over again. Third strategy is the unbalanced butterfly spread. And this is one that I use as a bearish hedge. So, and I only do this with SPX, which is the S&P 500 index, not just the ETF like the SPY, but the actual index itself, which is an extremely liquid options market. But it's an index, so you can't actually own shares. So you can't buy shares of SPX. You can only trade options on it, but it's very, very liquid for trading options. Um, you can do this on SPY or QQQ, but SPX is 10 times the size of notional value of SPY. So if you're trading one SPX spread, it's like trading 10 SPY spreads. So it's much, much bigger. But you can use the UBS strategy to create a bearish trade that has a favorable risk reward, and it will lock in profit anywhere about 1% above the current market price and below. So if SPX stays right where it is, even goes up a little bit, or goes down anywhere down, market crash down a couple points doesn't matter. We have a minimum profit that we would make on these kind of trades. And I typically am aiming for a 40 to 50% of my return on capital on these. But these are strategies that you want to put on when the market's just kind of grinding higher, and you want a little protection in case we get a big drop. It's not the kind of strategy you want to put on in a market crash or after several red days, because indexes like to bounce back hard from sell-offs, as we're seeing right now. This is not a time when we are have this just crazy bull market that we have right now. Not a great time to utilize this strategy, because it's like, as the adage it says, you're picking up pennies in front of a freight train, right? You're gonna get run over if you're constantly trying to short a market that is this strong. And that's where this strategy would kind of fall apart. So you don't want to do that in such a strong environment as this. But in typical market conditions, this is a great strategy to use to fade a move higher, and protect yourself. So maybe you use this as a hedge. You've got some bullish positions on, and then you have one of these on as a hedge to offset the losses you would incur from the bullish position. That can be a great combination approach to doing this. But again, that's a more advanced strategy. And then number four is the stock replacement spread. So the stock replacement spread, we're going to enter these very similarly to how we look at the cash flow collectives, where we're looking at maybe a daily chart, and we're using the yearly anchored VWAP, and so we're looking at slightly longer time frame, 2 to 5 week type of a position. But this allows you to trade a stock in a way that acts like you're buying shares of the stock, but without the capital requirements of buying the stock. So, if you wanted to buy 100 shares of Apple, which is a $200 stock, you would need to put up $20,000 to buy 100 shares of Apple. Well, with the stock replacement spread, you can control that same amount of shares for, maybe $1,000 or so, maybe $1,500. So you're using a ton less capital, one, and number two, you're also limiting your risk. There is a maximum that you can lose on these spreads, and so you don't have to worry about buying 100 shares of Apple and then Apple tanking and you losing, 5, 10, $15,000. That can't happen when you're doing this. One of the cool things about the SRS is that whereas our other strategies have an upside limit, we have spreads that have a maximum profit peak on them. The stock replacement strategy, it functions like stock. So if the price goes up, 20%, you continue, and then goes up another 10 after that, you continue to increase your profit on these spreads, just like you would if you own shares of the stock. There's not a point at which it has gone too far and you need it to come back against you now a little bit. You don't have to worry about that with these spreads. So they are more capital intensive, so you are risking a little bit more. You're probably, risking anywhere from $300 to $500 per spread that you put on. So you don't probably aren't going to want to do a lot of these in a small account. But a larger account, you could trade some bigger stocks like an Apple or Amazon or AMD, those kinds of companies. But this is a great strategy as well for smaller $20, $30 price stocks that you want some stock type exposure on, but you want to limit your risk and preserve capital as well. So those are the four strategies, an overview of the four, and I came in right on time here. We got about 15 minutes left for questions. So let me hear the questions that you guys have about any of the strategies or any ways in which you would want us to talk about the strategies differently or do something different with the strategies. I'm all ears on that. Go ahead and unmute yourself and let's just chat a bit about this.
So the stock replacement, it operates as owning stock, but as an option format.
Correct. When you're looking at a risk graph.
Okay.
So, so you think of a risk graph like a calendar spread, it has a profit peak and then it dips off. And so if it goes too far against you, you're going to lose on that calendar spread, right?
Right.
But if you look at a risk graph of buying stock, it's just a even diagonal line, right? In fact, um, I might be able to pull up an example here, and
Is there expiration dates for that?
there are, yeah, because we're using options, so there is an expiration date on it, and all of that I explain in the course of what expiration dates I use and why I'm using the ones that I'm using, and the reason I like this version better than just buying a call or buying a put. 'Cause when you just buy a single option, obviously theta is working against you, right? You're losing value. Your time value is decaying against that long option that you own. By structuring it the way that I do in that module, we significantly reduce the theta exposure. So it still functions like just buying a single option, but your theta is sometimes it might even be a slightly positive, but we're going to sell an option against the long options that allows us to capture the amount of time decay that we are going to experience in that long option. And I even show you how to calculate exactly how much time decay you're going to lose over a certain period of time and then sell an option that would cover that time decay loss. So it's a really neat setup for how to do that, and it works really really well.
Do you have anyone that currently runs three or all four of these?
Um, me one, but because the UBS and the SRS were just released this week, so I have not talked to anyone who has traded those yet within our community. I'm not sure anybody has gone through those modules just yet. But you, if you have the bandwidth and the account capital, you absolutely can trade all four of them at the same time. And you can structure them, and depending on how nuanced you want to get, you can structure them in such a way that you know you're playing them all against each other, right? And so you're kind of creating a comprehensive approach to the market that's allowing you to, benefit. You put on a couple of SRS trades that are going to be very bullish, and then you hedge it with a UBS trade that protects you in case the market goes down, right? And so you can kind of finagle that however you want. You just got to know what you're doing well enough to keep it all straight in your head because it can get real confusing real quick. But I would encourage most people to just pick one of the core strategies, DCS or CFC, and learn that one until you're really confident in it, and then add in another strategy. All right. Anybody else?
I've got one for you,
Yep.
Michael. Now, you know that I've had this account to do this set up for over a year now, and I haven't done the first trade uh, because I kind of got off on this mini gold contracts because it
Uh-huh.
goes in line, stays in line with what I do for a living a lot of the time. Um, and I think I'm hesitant to start doing the options because I just don't know much about that business. So I'm the oldest newbie in the room almost every day, everywhere I go. Uh, but what I kind of came to that conclusion that a guy ought to do DCS or CFC to
Hmm.
start with, and just feel comfortable about that. My question after saying all that is, what would be a good way to start feeling, what indexes could I watch?
Yeah.
What can I do to familiarize myself with the ebb and flow of how these products in the DCS, uh, how do I get familiar to where I feel like, yeah, I might,
That's that's a
that's where
great
I,
question. And I, it probably is a very helpful thing to use you as a case study here that can apply to everybody else too. Knowing the business that you're in, the world that you're in, dealing with coins and gold and silver and all that kind of stuff, it does make sense that you're paying attention to gold futures contracts because that is your business. And you can do the same thing on the equities side as well. You just watch, like, so don't really pay attention to all the different individual stocks that we're sending out. If you just pick, SLV or GLD, those are the two ticker symbols. SLV is the silver ETF, and GLD is the gold ETF.
right?
They're both fairly liquid, and both have good options markets. And I've traded SLV quite a bit recently with that huge move that we had and the back and forth that we've seen over the last few months. I would say just look at those two and and plot it on a chart with the yearly and the monthly VWAP and just watch how they react around those. And when you see one, when you see it come into VWAP and you're looking at a continuation setup, go to pull up an options chain for that security for SLV and use the structures that I teach in the course to create your own trade on SLV and just do
Okay,
that. You don't have to do the other trades that we're sending out. And I say to apply that to everybody. Uh, find a couple of securities that you really like. Maybe you give half your paycheck to Amazon anyway, so you just want to pay attention to Amazon stock, right? So or you're an Android user and you want to see Apple stock tank all the time, so you pay attention to Apple all the time, right, Aaron? And so you pick a couple of stocks and watch those individually. Maybe create a basket of 5 or 6 stocks that you want to watch, and just pay attention to those. That'll help eliminate a lot of the overwhelm of, man, I got a basket of 200 stocks that I'm trying to sort through and find one of them that's reacting around a VWAP level. You can skip a lot of that and just pay attention to a couple of them. But for you, Will, SLV and GLD would be the two I'd pay attention to.
great. That makes a lot of sense.
Josh, oh no, Josh says he has a mouse in his house. Uh-oh. I don't know if he's still with us or not. He's back. Oh, you're muted.
I've been back actually for a
Oh,
minute. So
good.
listen, so I caught the last part of that part. I missed a lot of the initial part of the new strategy, so I have to go back and kind of watch
Okay,
and
yeah,
see
yeah.
what kind of they all entail. So, but you are saying, I'm just making sure. So, but you're not going to send out like alerts on those, at least at this point. Is that correct?
That's correct. As of right now, my plan is to not send out alerts on UBS or SRS.
Mm-hmm.
that may change. I may decide I want to start doing that.
Sure.
But one thing I do am really thinking about. I haven't decided for sure yet, and I would like you guys to weigh in on this. I think I want to keep for now. I want to keep doing the DCS on Thursdays. Just send that report out every Thursday,
Mhm.
since that does include a bullish, bearish, and a neutral format. And then you can use that for the next couple of days to decide where you want to place your entries. I think that one will probably stay as it is. What I'm questioning is, do I keep the consistency of CFCs being done every single Monday? Because I mean, that's how we've done it for a couple of years now. Just every Monday morning we send out a CFC. But I'm kind of inclined to change that to more of a real time alert, where once or twice a week I'll send out that report as I see the setups happening
Mhm.
using that larger time frame. So we're using daily charts and a yearly VWAP. So the reaction time on those doesn't need to be quite as sharp as it does like with a DCS. Like, I mean, yesterday I posted the DCS report and I started typing it up and getting the screenshots and doing all of that. And by the time I sent it out, I think we were $4 lower on NASDAQ than where we were when I began the report. And so that's one that happens really, really fast. But
Mhm.
the CFCs, you got a little more leeway. So I'm thinking I might just send those reports out um, as those trades happen. Like I just placed one today on USO on oil, based on the yearly VWAP, and that would have made a great CFC trade. And then
Yeah.
everybody can decide, do they take it or not. So would you guys like to see that more of a once, maybe two a week, but certainly one? I can guarantee I would send out one a week, maybe even two a week
Mhm. Yeah.
as setups occur. Or do you like the consistency of me just, of you knowing that every Monday morning you're going to get a trade alert from me? What do you guys think?
I'm, I mean, I like the idea of more because to me, obviously repetition, seeing those things happen, learning to, obviously learning to see certain things maybe more and more. Because that's where I feel like it's almost like reps,
Yeah.
and the more reps you get in it, I feel like that's where I've learned, like, I, for about 3 weeks, I feel like I just crushed everything in a good way. And then, like, I feel like the last 2 weeks have just been like, a punch in the gut every day, but that's okay. Like it's just that's kind of part of the I feel like part of the thing, but
Yeah.
then like today, I took the what was it? The QQQ and I took bear in neutral or no, bull in neutral.
Okay.
So to kind of just hedge and see what happened.
Yeah.
And obviously the neutral almost it's technically up just a tad, but bullish is like I'm debating whether to close it today now. I'm like, it's
Yeah.
well
Aaron
past.
and I were talking before everybody
Did you?
else jumped
Okay,
on,
yeah.
and he's in the same position.
Yeah.
Um,
And I'm like, I got 2 more hours. Do I keep going and just let it just see how far it'll run, at the same time? I don't want to be like an idiot and then like Monday roll in and it's like we just everything evaporates or whatever too. So
right. Yeah. Yeah. All right. That's a tough call to make, but I
and
wouldn't
I
blame you
forgot to
for
even
taking
put
the
it on the
profit on
thing, so
it.
I took it. Do what's that?
I said I wouldn't blame you for taking the profit on it.
No, and I'll be honest, after the last couple of weeks, I'm kind of like, probably just gonna run and take whatever I can get at the
Yeah, green is
moment,
green.
kind of, yeah, kind of.
Take
Uh,
it and leave the neutral on. Is that what you're thinking?
well, that's how I was debating. Maybe just leave it on,
Yeah.
pull the bull that's the high. I mean, obviously it's run pretty good today,
Yeah.
and and then take it maybe today, see where things go, and then I guess if it keeps running, it could always pull the trigger again on Monday. I
If
guess I
if
don't
it
know.
if it keeps running, you could just add a new neutral
Yeah,
at the new strikes and keep the other
keep
neutral
it
on
keep it
as
rolling.
which
Yeah,
would effectively then it would become your bearish hedge, and
yeah,
you would have a new neutral in place. So yeah,
yeah.
that's a good strategy too.
Yeah,
So
that's
yeah,
I looked at adding the bullish today, but I readjusted the strike prices because it didn't make sense because it's almost bearish now.
Yeah.
right? 7-11 to 7-14, and
Yeah.
you bounced off of 7-10 and 50 cents. So
Yep.
Yeah.
I'm likely to close mine by the end of day.
Hmm.
Michael, we got into mine at 327 for the adjusted strike prices, and it just bounced off of 365, 369
Yeah.
within what, 3 hours?
Man, that's a 10%. That's a 10% return.
Yeah, I put in a sell order, so if it comes back up, it'll close. I'll take a 10% return in 3 hours.
Heck yeah.
Yeah.
But I'm probably going to close because we don't know what happens over the weekend, and we're one tweet away
We
from finding out.
Yeah, weekends are weekends can be a little scary.
Yeah.
I mean, I say they can be a little scary, but if you look at what has happened over the last 5 or 6 weeks, I don't think it's happened every weekend, but at least three of these last 6 weekends, Friday afternoon, Trump said something about Iran or something
Mhm.
that you would expect the market to react bearish to, right? Like, we're gonna start striking again, or something about the Strait of Hormuz, or something that would invoke a little fear in the market. And he waits until after the market closes on Friday, and then Sunday night when futures market opens, it gaps down 1%, and you think, oh man, we're gonna be lower, and it may even open lower on Monday,
Yeah.
and then immediately gets bought right back up.
Yeah.
Like, that's the way it's gone a couple of times now over the last few weeks. And but that's all that to say, those kind of reaction things can happen over a weekend, and have happened a couple of times recently. So I too would be looking at taking my profit on a bullish one, leaving the neutral on, and then seeing what happens on Monday.
Yeah. Yeah,
Not
that's
a
kind
bad
of what I was
approach.
wondering. That's good to hear your insight on that because I was
Yeah,
kind of like, man, it's like, yeah, I don't want to get killed over the weekend or whatever. And
for
at the same
sure.
time, yeah, enjoy the win of the week and go,
Yeah,
okay, hey,
and it's always
we
good
won.
to go into a weekend on a win, right?
Sure.
That's
Yeah.
always a nice thing.
Makes the weekend feel a lot better.
It
So
does. Yep.
yeah, for
Okay.
sure.
Any
But
other questions? And
no,
one.
I was going to say, I would love to see more of what you're doing throughout the week. Yeah.
Okay.
And I
Yes.
think I
Yes. Yes.
said
That's right.
that,
That's what we were
like
on.
obviously, yeah, to see kind of, the things and be able to kind of see okay, where is this going and what's that look like? What made you pull that versus the other or
Yeah.
something like that. So,
Okay.
insight's always good for sure. So it helps me. So,
Okay. Awesome.
yep.
Well, I will probably still send one out this Monday morning, but in that
Sure.
report, I will say from here moving forward, it's not just going to be every Monday morning. It's going to be as trades occur. Um, Will, Aaron, you guys think that's a good?
Yeah, my only question is time consuming wise, what's it take to put together? And is there a easier format that you could just put a comment on your weekly CFC and said, I did this? Versus sending out something, because there's two things that's happening, right? Is you're giving us all the data to buy, which is easy, right? Click, copy, trade. The second thing that's happening is you're hand feeding, right? Some people maybe are learning how to add the trades and buy and sell. But if you're just posting what you did and why, that's probably more insightful for our growth than spoon feeding us a click and follow.
Yeah, yeah. I think I could on my end make it less time consuming, because it's not terribly time consuming to create those reports, because it's just a template and I just go in and replace the
Okay.
numbers. So that's not necessarily the tough part. But I could probably make it even more efficient and just post make a post every week with kind of a bias of the market, or here's a list of 5 or 6 stocks I'm watching this week to come. If they come to a VWAP level, I'm looking to make a trade. And then in the comments under that, I could just literally just text at everybody, bought this spread, and so it's just text within that comment. So every week we have a new CFC post, and then comments underneath it for each trade that we take. Something like that. Is that kind of what you're?
Yeah, I just don't want to overwhelm the person that's putting out all the data, right? And I don't want to be reliant on all of your data.
Yeah.
I like to copy links because it makes it easy. But at the same time, a lot of times I text you, I'm like, hey, I'm wanting to change this. How do I update this?
Yeah.
Versus just learning how to do it.
Right. Okay. That's some good things to think on.
I kind of like spoon fed.
Yeah.
That being said, I haven't done the first trade, so I don't have a real opinion.
That's good.
In fact, I'm still nursing and haven't even got to a spoon.
You don't even
yet,
have a spoon
so.
yet.
That's right.
Okay. Awesome. Well, that's a great segue into the last couple of slides I've got here. The whole objective of everything that we're doing here is to create this kind of a path for you where we go from being in stage one where you're immersing yourself in those three E's: the education, the experience, and edification. So you're learning everything. Maybe you're completely brand new. Maybe you have some experience with it, but you're just struggling to become consistent or whatever. This is where you're going to start at in stage one, and this is basically the I do, you watch. Right? You're copying my trades. You're just maybe not even fully understanding why we're doing what we're doing, but you trust me enough to follow along with the process, right? So I'm doing it and you're watching. And we want to move from there into stage two, which is that guided practice. And that's where, sure, you may still be copying trades from the trade link and those you're just clicking a button and duplicating what I'm doing. But you're also able to look at a chart and notice, okay, here's a setup. This is a setup. Here's a continuation. This is a fade. Here's where we saw a reclaim. You're able to do that more on your own. And you're posting trades in the member trade review. You're more actively engaged in the community space side of things. And so this is where you're doing the work and I'm watching you as you do it. Right? So we go from I do, you watch to you do and I watch. And then we want to progress you to stage three, where you're executing these trades independently. You can identify the setups, you know what buttons to click to place your order, you know how to manage the trade, how to exit the trade. You've got the system down, and you're off to the races, and you're doing this consistently. And so this is where you are doing what I'm doing without me. Right? So we go from I do, you watch, to you do, I watch, to you're doing what I do, but you don't need me to do it. Right? So that's the progression of what this entire program is designed to guide you through to get you to that stage three where you can do all of these same things and you don't need me to help you with that. Right? So if this looks like something that is appealing to you and you want to be a part of this, if you're watching this and you're not a member of the community yet or not a member of the premium side of things, then here's the next step. So become a member. You get a walkthrough every single. We'll do these kind of walkthroughs on a regular basis. We do a monthly group coaching where we'll go in-depth dive into an individual strategy. So you get that live guidance, trade alerts, coaching calls, ongoing support, tech support, all that kind of stuff. Want you to be a part of that with us, and you can start with a completely free trial, 7 days at no cost to you to get full access to the course, all the pre-existing trade alerts, everything that we have is at your disposal to learn over the course of a week and see if this is the right thing for you. And if it's not, you can cancel and never pay a dime. If it is, like most of the members of our community, you see the value in it, you stick with it, and you learn to develop this skill over time. I would love for you to come be a part of this with us. You just go to stocksforpastors.com and join that membership today. Just click the join membership button at the top, and that's where you can get into the full access to everything that we do here, from the structures to the coaching to the real-time alerts. All of that's going to be available to you as a member of Stocks for Pastors. So Thank you guys for being here. Thanks for joining us for this training, and we look forward to doing this again real soon. Talk to you guys next time.